Welcome to Business Today. I'm Michelle Flurry in New York, where traders may want to put on their hard hats. That's because as markets picked up where Japan left off and the global stock market intensifies as the sell-off continues. There are two things that do seem to be driving it: Friday's disappointment about how few jobs the U.S. economy added in January and Japan's decision to increase interest rates last week. Well, as you can see, the U.S. markets have opened sharply lower. You can see the Dow Jones Industrial Average losses there are, oh well, it's down over a thousand points at the open. The S&P 500 crucially is down 4%, and the NASDAQ, the tech-heavy index where we've seen some of the biggest losses, that is down over 6% at the opening bell. And this is what happened in Japan, and also the picture across Europe. As I was saying, a lot of this negative sentiment seems to be because only 114,000 jobs were added to the U.S. econ in July. Now that was much lower than expected, and that raised fears that the world's biggest economy is slowing, and you're seeing that rippling across those markets which we were just showing you around the world. Now on Wednesday, Japan's central bank increased the cost of borrowing, with its main interest rate going to around 1/4%, which is the highest in 15 years. As a result, September 18th is one day many people are looking to. That's when the U.S. Federal Reserve will make its latest interest rate decision, and investors are wondering if they will cut the cost of borrowing enough to stimulate the economy. Kaminsky is chief research strategist at the investment firm Alpha Simplex and joins us from Boston. Katie, what is going on with the markets at this point? Can you say this is a rational fear, or is it irrational? This is a very good question, but it definitely looks very much like the market is experiencing a recession, trade risk-off behavior, and we have to remember that the market has been priced for a Goldilocks type scenario, a situation where tighter rates and tighter policy doesn't have strong economic consequences. As a result, we're starting to see people come to terms with, or at least have a trigger point, that maybe that's not the case, and as a result a lot of people are trying to take profit on high valuations. I mean, let's talk about, for example, Nvidia's share price. It's down, what, 10%? That was right before the opening bell rang. What does that tell us? I mean, it was one of the hottest stocks. Did things become overpriced and now this is just people sort of retreating? Or do you think it is a sign that there is really more danger in the economy than people had previously anticipated? Well, I think we have to point out that the data has been coming in weaker for about 2 months, and the narrative in the markets has been shifting. Initially we were thinking about inflation as a concern that has tempered. Now the narrative is moving towards the potential for demand destruction and economic weakness. If you look at some of the data, like housing isn't doing as well, manufacturing data has been weak for some time here. We're also seeing savings rates down, consumer debt rising. So the question is really, is the market ready for a correction? Because there's economic weakness that will be fueled by more economic uncertainty or political uncertainty, and as well as high valuations will cause people to want to get out of those positions now. I mean, Katie, a lot of people are looking towards America's central bank and what they will do next to ease. But if you look around the world, you've got the ECB that has cut already, easing there. You've got Japan that just hiked. How is that sort of feeding into what we're seeing? Is this just a U.S. story, or that markets around the world are reacting to, or are there other factors at play? Well, I think it's a little bit of both, but what's most important for the us right now is the fact that this type of data and this type of market reaction suggests that there's a lot more pressure on the Fed than there was a week ago, and as a result, with September 18th so far away, I think there's going to be a lot of concern about how the Fed can react, or could they react faster? I know that pricing on rate hikes went up significantly in the last 2 days, so you're seeing that convexity, that sort of nonlinear moves, that people are really realizing that this is going to have to be dealt with. Kaminsky, thank you so much for joining us on this fast-moving day. And now we can turn to Stephen Blitz. He is chief economist at the economic consultancy TS Lombard. Thanks for Joining us on the program. Look, if this was sparked by a growth scare, particularly we had that weak data last night on manufacturing, the ISM report, and then the jobs report on Friday. Can you give us a sense really how bad things are right now with the US economy? Well, it's not a question of things being bad right now. I think they're definitely soft, right? But and if the Fed's going to wait for things to be bad to act, then it's too late, right? Because there is a lag in the time between the Fed acts and when the economy responds. So the issue is, and the concern here is not so much that we're in a recession today, because we are not, well, we mean the US economy, but what we are in is a position where you're getting all these warning flags and signs saying that if the Fed doesn't start to cut, and cut a lot soon, we will be in recession by the end of the year. Now, Austin GBY is president of the Federal Reserve Bank in Chicago. He was saying a short while ago that we shouldn't read much into one or two pieces of data, and reiterated the line that we've heard from a Fed chair, Jerome Powell, that the Fed is data dependent. What, do you agree with that? I don't. All right, I mean, I do, in the sense I understand what he's saying, but that is the trap that the Fed, all central banks really always fall into. Well, we need one more data point, we need a little bit more. We don't want to react to one data point. All well and good, but they were starting from a point where the short-term money is at 5.5% and inflation is essentially at 3%. That's a 250 basis point spread. Money is tight, and the longer they stay there, the greater the odds that you're going to be in a recession. At some point, the weaker data, the weaker earnings data that we've seen beyond you know that the top 7 there, it's all telling the same story. Not a recession, but economy is weakening. And if they're gonna wait to see actual collapsing data and then say, oh, here we are, we should start cutting, it's too late. So it sounds like you think the Fed is behind the curve. What happens next? Does that mean a bigger rate cut in September, or what the markets seem to be asking for right now? Could we see an emergency rate cut on the table? At this point, I don't think you'll see an emergency rate cut unless this sell-off in the equity market, which at this point I think is a little bit of this, is some of the air exuberance, or the certain stocks sort of coming back to the mean. So unless there's some emergency, I don't see a mid-cut, a mid-meeting cut. Did they cut again? Did they cut 50 basis point in September? If we see another sub 100,000 job number enough for August, and we see weak retail sales as well in July and August, the answer is yes. And really, by any model, including John Taylor, the Aunomus Taylor rule is saying that the funds rate should be at 4%. So they've got a long way to go, and if they want to take their time cutting, that's their business, but they'll do the cost of that will be a much more rapid acceleration in cutting later on when we're already in recession. So this is about avoiding recession, which was always their promise. Their promise was we could get to 2% without inflation, without a recession, and if the economy starts to slow and we have a lower inflation rate, we being the Fed will not let the funds rate push us into recession. That's where we are. So job not yet done. Stephen Blitz. Thank you very much. Thank you.